Alrighty, go ahead and click record here and we will go ahead and get going.
Recording in progress.
All right, welcome everyone to today's Sunday macro wrap up for Sunday, February 2nd. Man, seems like January was pretty long. That's because it was actually almost 5 weeks, which is pretty abnormal. But now we're getting into the second month of 2025 already. And we'll go ahead and get right into it here. So as always, we're going to leave this hour for this Sunday macro wrap up here. The first 30 minutes will be streamed. The last 30 to 45 minutes, the public stream will end, and it'll go only for Macro Optics members to go over some charts as well as some ideas that I got. All right, so I don't know if you guys have ever played those Tony Hawk video games, but it's interesting that the way that when I look at this picture, I think of what the market is thinking the Fed is doing. Because if you guys have never played this game before, as you are grinding down these rails, you have to balance it with that meter that's right above here. And if you go too far on the other side, then you wipe out and you crash. And so what the market is trying to do is, as the Fed is grinding this, we can call this the soft landing rail. If it gets too far on one side or the other, then that could be trouble, and it would take away from the Fed's credibility of what they're trying to achieve, which is a soft landing, right? And so if it goes too far to the left, then that would be a hard landing where you get deflation and negative GDP, where on the other side, you get hyperinflation and a too hot of an economy. And so what's happening right now is, obviously the big news is the Trump tariffs, which we'll get into detail in a few moments. But when we get data that is not at this equilibrium on this soft landing rail, that's where the markets get freaked out a bit. And so with these tariffs that are in place, the overheated economy happens where inflation picks up, things get very expensive in the short run, and that's something that the market doesn't want. What it wants is the Fed to achieve its soft landing by continuing to disinflate inflation. So disinflation is when the rate is still positive, but it's getting close to their 2% goal. And then they also never get negative GDP, meaning they avoid a recession and inflation comes back down. But with these new tariffs that are imposed, what the market is scared about is consumption and demand will fall off while inflation goes up. And that's something that is the opposite of what the market wants. And so you're leaning towards one of these ways a little bit too far. Not to say that's what's going to happen. That's just what the markets are attempting to price in at this very moment in time. And again, we'll get into everything that happened and go over the exact fact sheet directly from the White House here. But as always, with these Sunday macro wrap-ups, what I like to do is I like to go over some of the data highlights from last week and then look at what's going to happen this coming week during this first week of February here. So on Monday last week, it wasn't too crazy of a macro data dump, although it was a decent amount of data. We continue to see more data that supports that there's a housing freeze, so prices remain elevated, demand remains really low, and there doesn't seem to be much budging happening in the housing sector in the United States, mainly because interest rates are not coming down. That's not really the large news, which we'll get into in a second here. But we also saw that the Chicago Fed National Activity Index remains negative, which this National Activity Index, it takes a look at both consumption as well as producers. And as you can see, it's pretty much been negative since the beginning of 2023. Normally you don't see that until, it's leading up to a larger slowdown. Not to say it has been improving over the past couple months, But it's just showing that the market and the real economy still isn't in a recovery phase yet. It's still in a negative phase. Consumer confidence reflects this as well. So a lot of the optimism from the election results pretty much faded with this conference board consumer confidence measure. So we saw it go right back down to just 5 points after it was 104 points in December. So that's more back to reality. That was something that we were talking about over the past couple weeks. Manufacturing new orders remains negative, as well as we're starting to see the service sector of the economy. So the United States, you can think of as a more service-based economy where the rule of thumb is 80% services, 20% goods. And so when you start to see the services economy weaken, that is something that you have to pay attention to because that makes up the majority of the economy. But we're still getting some manufacturing data that is improving, like the Fed manufacturing index or the Richmond Fed manufacturing index, which makes up of these states in the east side of the United States, and that has just been getting less negative, which can be considered as improving. And then on Wednesday, we received that the trade deficit on goods, and this ties into the Trump tariffs, that had its largest deceleration, it's had the largest deceleration since March of 2022. So before that, it was just in March, but there was a large decline, which is what brought the entire GDP number down, and this is due to imports accelerating. And so when you take a look at the calculation for the GDP number, the net exports is exports minus imports. And so if imports are increasing, that takes away from the GDP number. And so this is what brought the estimate down from just 2 days prior, or the day before actually, it was 3.2%. And then it went all the way down to 2.3% because of imports accelerating. Mostly because different industries in the United States were trying to get ahead of these Trump tariffs, because that was one of the things that Trump mentioned on the campaign trail in November, was that he was going to do these 25% tariffs on both Canada and Mexico. So this shouldn't be too much of a surprise. Maybe it's a little bit of a surprise for how soon Trump did it. I think that's what the market is really trying to factor in here. But that's what brought a large deceleration in the GDP number. And so you can see that reflected here, looking at the real GDP number for Q4 of 2024. It went from 3.1% to 2.3%. Not as bad as Q1 of 2024, but it's still a deceleration nonetheless. And then we also saw that the annual rate for pending home sales declined, which makes sense because rates are higher than average, or higher than what was previously thought. And then lastly, on Friday, we got personal consumption expenditures. So this is one of the Fed's preferred inflation gauges. Hold on one second. Let me fix the screen here. So this is one of the Fed's preferred inflation gauges. And as we saw from CPI, as well as just the other inflation measures that we take a look at, this has accelerated for 3 months in a row, which was already priced in. So the PCE number is pretty much a lagging confirmation. Now, getting into the juice. So as we know, President Trump imposed a 25% tariff on Canada, a 25% tariff on Mexico, and a 10% additional tariff on China. And these are goods imports. So keep in mind that you have both goods and services, but most of the services stays in the United States, and we import most of our goods. But when breaking it down, it is pretty interesting. So just to give you guys a little bit more of a context here, where is it? I was trying to see when he was saying that they were going to stop it. It's in somewhere over here. I can't find it, but I read it beforehand, and he's not giving. Okay, here we go. The tariff will remain in effect until such time as drugs, in particular fentanyl, and other illegal aliens stop the invasion of our country. So, the reason why I'm reading that is because he's not giving an exact date, and it's just dependent on all of the policies that he's enacting. And so it's unclear when these tariffs will be lifted. Now, what is a tariff? A tariff is essentially just a tax that a country imposes on imports. And this is specifically with goods. And as I mentioned before, goods, they don't make up too much of the total United States GDP. So looking at this chart here, this is a chart of the entire imports and goods. And then hold on one second. Oh no, this is imports and goods that the United States has from the entire world. And then in terms of imports versus GDP, that's only at 9.2%. So effectively, imports only make up about 9% of GDP, which is relatively small. Now, when taking a look at imports of goods from Canada as well as Mexico, adding just those two components of all imports that the United States takes in comparison to GDP, that's only 2.7%. So just to think about it for a second, because I know that there's a lot of news out there, let's just look at the numbers. These tariffs only affect the United States by not even 3% of total GDP. Now, that's still a lot, but it's not something that's going to send the U.S. economy into a meltdown. So we have to keep that in mind. And then also as well, when taking a look at the other side, so for all the goods and services that the United States exports to Canada as well as to Mexico, actually, let me back up here for 1 second. When it comes to the export side, so this is how much of the United States consumption makes up both Canada and and Mexico's GDP. Well, if you go to the United States trade agreement website, you can pretty much see what this was for the past year. And what was interesting is that exports make up nearly 20% of Canada's entire GDP. And so what makes up a large portion for Canada makes up a very small amount by about 10x for the United States. As well as with Mexico, Mexico is even larger, which is at 32%. So exports just to the United States from Mexico make up 32% of their entire GDP. And so the total trade with the United States for Canada is around 32%. And then the total trade with Mexico is it's nearly half. So nearly half of Mexico's entire GDP is with trade with the United States. And so what's interesting is that as we see these other governments, so the Canadian Prime Minister as well as the President of Mexico, they retaliated saying, well, we're going to impose our own tariffs on United States imports. But as you can see, it only affects 2% of all of our goods. Now, there's obviously some of those things translate to the services sector, right? Because if you're getting higher food prices on things that we import from Mexico, and then I think the largest import that we take in from Canada is either crude oil, I believe, as well as natural gas. And so, obviously those particular sectors, we might see an increase in those prices. So if you go to the grocery store and get avocados, they might be a little bit higher. Or if you use natural gas or propane tanks, the price of that might be a little bit higher. But all in all, in terms of the entire market, these other countries imposing their tariffs on the United States, it's even going to hurt them even more. And so it's a battle of short-term versus long-term. Which one is going to win out? Obviously, the United States has an incredibly large advantage. And so this is just something that was not too much, that it wasn't intent, or it wasn't the magnitude of it wasn't being priced into the market, and that's why you're seeing a little bit of a scare from prices like Bitcoin. And so the purpose of this is to just say that Canada and Mexico have more to lose with imposing their own tariffs than the United States, and it doesn't affect the United States as it does these countries. So we'll see what happens, and we'll see if this turns into a trade war, which in the short term does have pain on both U.S. and foreign consumers. And so we'll get to the charts here in a second, but that's pretty much the Spark Notes and more data-based version of the Trump tariff news. Taking a look at the Atlanta Fed's GDP now for Q1 of 2025, that was at 2.9%, so it's slightly higher than the most recent one. It's a little bit too early to tell, though. Pretty much you want to start really paying attention to the GDP now metric from the Fed, from the Atlanta Fed around late February, early March, because that's when it'll get a little bit closer. Taking a look at the Cleveland Fed's forecast for inflation, we can see that the CPI number is slightly, or it's about going to be the same, which is an increase from before. So the previous estimate, which I don't have available, it was around 2.6%, and that jumped to 2.85, which if you round it to the just one decimal point, that's 2.9, which is the exact same as it was. So the market was anticipating that inflation was going to come down for the month of January, where it looks like it's going to remain flat, which is an increase from the expectations. And so you're seeing a negative reaction. When looking at target rate probabilities for Fed funds, we can see that right now there's an 88.5% chance that they continue their pause regime. So they're not going to be cutting according to the March 2025 Fed meeting for what's in place. Now, this could change if we see a large drop off in inflation, or possibly if there's a huge crater in GDP. But as we discussed, these tariffs aren't going to crater the United States economy, and yet has to be seen with the effects on inflation. So we're not seeing too much of a price change there. And I believe the first cut, okay, now the first cut, there's a more of a percent chance that they're going to cut in June, which beforehand it was July, and it has moved up. I think it was about 5 weeks ago or 4 weeks ago where the bond market was pricing in that the first cut was going to be in September, and that has moved up from July to now June. So the market is pricing in something here. And again, this has to do with both growth and inflation, depending on what happens. And that all goes back to how the Fed's grinding the soft landing rail. Just to go through some other checkpoints here, the Chicago Fed National Financial Conditions Index is at levels that are similar to the beginning of 2022, as well as late 2021. So financial conditions still remain pretty loose despite interest rates remaining higher. And what's interesting is that because the initial as well as continuing jobless claims have been improving, the labor market scares have pretty much faded altogether. So we had a large drop off in continuing claims, meaning people are finding jobs. So when you see continued claims drop off, that means that people who have been on unemployment for a while, they are now finding jobs. And then as well, we have a decent deceleration so far in the beginning of the year. The end of December is around 8.5% year over year, or now it's 1.4. So the employment metrics are improving, meaning the labor market is coming down from its tightness, but it's still pretty tight. And then just getting into some of the earnings last week, we had big tech, Apple, Microsoft, Meta, as well as Tesla. There was a little bit of a surprise from Tesla, even though it had a bump, and then Microsoft had a shock and had a large drop off as well. And then there was some implications with Apple because their iPhone sales dropped off. And if you looked at it in real terms over the past 2 years, it's actually negative, but it did have an acceleration in its service sales, like cloud services and things like that. Next week, so this week coming up, We have Google earnings as well as Amazon. So those are the other two mega cap tech stocks that are going to be providing earnings next week. Let me see what days those are. So that'll be on the 4th. So Google will be on the 4th, and then Amazon will be on the 6th. So that's Tuesday and Thursday, respectively. Taking a look at one of my favorite long-term indicators. So this is the OECD CLI Diffusion Index, which is a mouthful. But essentially what this takes a look at is the year-over-year and month-over-month change in this diffusion index, which takes a look at the economic data from all the other major G7 countries around the globe. And so this is a global index. And what's interesting is that it does have a leading mechanism towards the S&P 500. And so when you start to see both the blue and the red start to decelerate at a faster pace, that typically front runs the top in the market. And as of right now, we've seen the month over month number decline, where the year over year number has still remained elevated, similar to what we saw back in July of 2021. And so, that put about 6 months towards the peak from when this signal happened versus the peak in January of 2022 for stocks. So not to say that's going to happen not to say that's going to happen in the same way this time, but there's a lot of other analysts that are also suggesting that around summertime, things are going to be a little bit tough in the financial markets. And it's just interesting that this unrelated metric is also saying that as well. So I do think that there are going to be more headwinds this year for the stock market than there were over the past couple years. I don't think, as of right now, from the metrics that we're seeing, that we're going to have a full-blown recession. But I would not be surprised, and there's a high likelihood that the returns for the S&P 500 are not going to be the gangbuster returns that we've seen over the past couple years, which were very abnormal, right? So the long-term average of the S&P is about 10%, and we had both, I think it was 25% back-to-back almost. So those were outlier years. So I would not be surprised if we had a lower year. Now, what's interesting is that when taking a look at both bank credit and the M2 money supply, we see that the bank credit year-over-year rate of change pretty much peaked in November of 2024, and it's remained pretty stagnant. It's pretty similar to financial markets, right? So it's similar to how the S&P 500 has remained stagnant. And then when taking a look at M2, if we really zoom in here, that also peaked at the beginning of December. Actually, it peaked in November, early November, and it's pretty much remained around 3% year over year for the past 3 months now, 2.5 months. And so it's not surprising that when you take a look at the S&P 500, that it's also remained a little bit stagnant. Equity markets are highly sensitive to money supply these days, flows, as well as bank credit. And so that's why we track those on this channel. And the reason why we're having a lot of this crazy volatility is solely because we are in a new regime. One of the things that I like to talk about a lot is this new temperamental era in the markets that we're now experiencing that we haven't been in for the past 30 years. And this is a chart here of the 10-year Treasury bond yield. And as you can see, look what happened after COVID. I'll blow this up a little bit. So the 10-year Treasury bond yield pretty much has been declining, meaning that financial conditions have been pretty much easing over the past 30 years. And now there's been a rapid acceleration. And so just by looking at bond yields, which again, this is what lending rates go off of for 30-year fixed mortgages, credit card interest rates, all those things. As you can see from the pandemic, this has been just accelerating very fast. And I don't see this slowing down anytime soon, or coming back down to the levels that it was pre-pandemic. And so we are now in an era where the average inflation rate as well as the average interest rate are going to be much higher than we've experienced over the past 15, 20 years. And that's typically the normal range. If you go back all the way in time to the 80s, 70s, and 60s, pretty much from the 2008 great financial crisis to the COVID pandemic, we have been getting too much used to low interest rates and low inflation. And so a lot of people were getting used to that as the norm, but that was really the outlier when you take a look over the past 50 or 60 years of the stock market. And the reason why I'm sharing this is because this is just different. We're going to have to not rely so much on just buying and holding things, and we're going to have to rely more so on active managing our own portfolios in a way where we can limit downside and keep our purchasing power ahead of this higher than average inflation. And so I really think that, gone are the days of just, buying a stock, closing your eyes, throwing a dart at an ETF or a stock and just, all right, it's going to go up. I think you have to be way more strategic in this type of regime. And that's really what we're aiming to do here at Macro Optics. And so finally getting into the charts here, we had a very interesting month in the markets. The S&P 500, we just took a look at bank credit, and it's similar to what we saw here, right? So where did the S&P start to lose momentum? It was right around here, and pretty much this November 11th number, which is when we saw that stagnation in bank credit as well as M2. I mean, look at the stock market. It stopped going up the way that it was. And not to say that's the only reason, but it is a fundamental case for the reliance on bank credit as well as the supply of money. Oops, sorry about that. I need to change my screen for you guys. Let me put a 1 in the chat if you guys can see the screen now. I think it's there. But yeah, so what I was mentioning is that it's not a surprise that we saw a stagnation in the S&P 500 as M2 and bank credit has also been stagnating. And just looking at the performance over the last month, the best performing sector is actually the healthcare sector. So taking a look at a chart of XLV, that had a large acceleration from where it troughed in mid-December. And ever since then, it's had a very large bounce to the point where it's now back to bullish trend. And for those who are members who are going to stick around after the call here, we're going to get into a couple of healthcare stocks that we're looking at. But also as well, the other top performer was the price of gold, which gold has historically, it does pretty well in stagflationary environments. So let me see if I can find it. Here we go. So yeah, similar, gold was one of the top performers in January. We also had the financial sector, so XLF. And then we also had communications, and those were pretty much the top ones, as well as materials. But really, healthcare, gold, financials, and communications were the best ones. And what's interesting is that those types of stocks have to do with services in the economy, not so much goods. And so when we go back to the Trump tariffs, what sectors are going to be very resilient are the ones that have been performing already, because they're more services based. They're not as much goods based. So, if you take a look at something like consumer staples, which does heavily rely on goods, look at this chart. It's a completely different chart. That's bearish. So that is pretty much what I'm looking at here. We can just go through some of the other data points as well. We're seeing a large decline in net central bank liquidity as well. So this was mid January. It was around 6 trillion, and now it's at 5.85 trillion, which is about a $200 billion decrease in central bank liquidity, and it's near the low end of its historical from when it paused in June of 2022. The Fed is continuously running off assets on their balance sheet. There's no change there. That's QT. We've had a rise in the Treasury General account. I don't know why. I was anticipating that this was going to start to decline because the RRP, which has been the greater source of a lot of this liquidity, that's had a large jump. And I marked this $100 billion mark for the RRP because that's really where it's stalled out, and it hasn't had a chance to get below that to supply further liquidity in the markets. And so at the same time that all this is going on with fiscal, we're also seeing a decline in net central bank liquidity. As you guys can tell, when it comes to the markets, there's different things happening this year than there were the last couple of years. Not to say that, things are going to be doom and gloom. I've just pointed out 3 sectors that could perform and currently are performing well in this environment. So don't just say I'm being bearish here. Now, the volatility index of the S&P could spike on that, which it looks like it's doing now. 10-year U.S. government bond yields remain in bullish trend. And if this does form a higher low here and continues to accelerate, that would put even more pressure on what's currently happening. And then what's interesting as well is that look what the dollar just did on this Trump tariff announcement. That's huge. That's an enormous move for the dollar. Conversely, looking at the Canadian dollar, yeah, not so great. Not so great. So this environment, high interest rates, high dollar, high inflation, you got to be strategic. It's not just a buy and hold scenario here. And so I wouldn't be surprised if we, see a dip in a lot of the major tech sectors tomorrow, and then continuation for gold prices. Let's talk about Bitcoin. So for the people who are wondering, when Bitcoin is going to diverge from risk assets and U.S. equities, doesn't seem like that's happening anytime soon, as it almost has a similar chart to NVIDIA. But, Bitcoin and digital assets are on the far end of the risk on the far end of the risk spectrum, excuse me. And so when there's ample liquidity, when there's a lot of risk taking, when people have money flowing over, they go farther out on that risk curve. And so it's not a surprise that what we've been talking about, Bitcoin has severely slowed down in terms of its momentum from where it was, at the beginning of October. And so going back to that notorious November 15th date that we saw from bank credit, look what it's done. It's pretty much remained flat, even though it's had, large ups and downs. This double top here at around 106K. And so not to say that I am bearish on Bitcoin. It's lost a ton of momentum. It's still technically bullish in our model, but I'm not jumping into this. And so taking a look at what I've been talking about for a while, which is stablecoin dominance. Stablecoin dominance is you just put in a new local high. So as you can see, since the beginning of December, stablecoin dominance, which you can think of as people running to safety, has formed higher highs and higher lows. The last time that we saw this was back in March of 2024, which was the last top in Bitcoin. And when Bitcoin dominant, or when stablecoin dominance had this run up, that's when you had a lot of trouble in the markets. And then when we just had that rally, what did stablecoin dominance do? It dropped off, People are getting out of stables and going into crypto. Now the opposite is happening. So just looking at stablecoin dominance, that in the crypto markets, people are going more risk off. Not to say that this can't turn around if something happens, but this was a trend that we identified at the beginning of January to stay cautious about when it made this move here. And then when taking a look at total DeFi dominance, so this is market dominance in cryptocurrencies for just DeFi tokens, that's in a clear bearish trend. And then when taking a look at the altcoin dominance, so this is the total cryptocurrency dominance, excluding the top 10 cryptocurrencies. So you can think of this as altcoin dominance. That has dropped off as well. And we are at new lows. We haven't really seen it be this low since June of 2023. So definitely not altcoin season. There are a select few that are performing well. XRP had a pretty decent drop off. It still technically remains on a bullish trend, but yeah, that's a large down candle there. Hopefully people were taking profits in this area. But that's pretty much what I have. That's pretty much what I have for you guys right here. If you guys are joining us live on Instagram, TikTok, or YouTube, what we're going to do now is transition over into just the members only for a Q&A session. If you guys are interested in joining that, you can just go to the link below or the link in my bio for our school group, where you can gain access to these weekly calls as well as some other resources in order to further help you learn more about this macro environment that we just talked about, this more temperamental period in the markets. And so you can learn more about our school community there. But that's it for our live stream for the Sunday Macro Wrap Up. Good luck out there, and we will catch you guys